I know that hating corporate landlords might seem like the answer, but I promise by the end of this video, you'll learn to love the greedy buggers. This is because the truth is that the fastest rent control isn't a law, it's inventory. When housing supply surges, prices finally crack, and Redfin's analysis argues that banning corporate landlords won't fix affordability because it doesn't add homes and it could actually slow building. Meanwhile, the S&P Case-Shiller Index shows cities like Tampa are cooling as listings pile up, which is a result of record levels of inventory. In this video, I'll map exactly how oversupply is pulling prices down and how investor greed chasing high rents created the very inventory situation that's now resetting the market. The truth is, if you want a good deal, you need to follow the inventory, not the outrage. And in today's video, I'll show you what the data is actually telling us and how you can use this information to save money when you buy a home. So you may be asking yourself, if rent control isn't cutting rents fast, then what is? And why are some prices easing without new laws being passed? Well, the short answer is more supply. You see, when listings surge, landlords lose pricing power, and that shift shows up in rental prices as well as seller concession and days on market before any new law shows up at City Hall. The truth is, the fastest way prices fall is through a wave of inventory, not ownership bans or headline-grabbing crackdowns on corporate landlords. This is because when more inventory hits the market all at once, like new builds finishing, investors listing properties, and accidental landlords resurfacing, buyers and renters get options, and options turn into leverage, and leverage turns into, well, you guessed it, lower prices. And though a lot of people blame corporate landlords for high rents in the first place, the counterpoint is actually basic supply and demand economics. You see, if there aren't enough properties available, someone will pay a higher price. And when supply expands, even powerful corporate landlords have to compete by dropping prices and therefore dropping their rent. And that's why the focus on who owns the home is actually just a distraction from how many homes are actually available, which is at the core of the housing affordability problem. Because here's what happens when you actually target big investors. Redfin's analysis shows that when policymakers try to sideline large buyers, sales just migrate to smaller investors and individual purchasers. Total demand in the market doesn't disappear, it just changes lanes. Meanwhile, limits on larger buyers actually slow and complicate financing for build-to-rent communities as well as multifamily projects that can build more housing quickly. And this bottleneck actually hurts the very outcome that renters and buyers need, which is more homes. And Redfin's argument is straightforward. Restricting certain buyer types doesn't actually create housing supply. New housing comes from zoning that allows it and builders that can build projects that make financial sense, meaning that when cities reform zoning, which is things like legalizing duplexes, fourplexes, ADUs, or accessory dwelling units, as well as taller multifamily buildings, developers respond, lenders get comfortable, and crews go to work, and that's where the new supply starts, which puts downward pressure on prices. Think of inventory like air pressure. When there aren't very many listings, prices get pressurized upward due to low inventory, and more buyers are competing for that same inventory. But when inventory goes up, the pressure releases because each extra home on the market is another little valve releasing pressure and driving prices lower. And there's also big money at play behind large-scale supply. In an article that was recently published in Fortune, they cited independent studies showing that institutional money isn't just flipping houses, it actually finances construction pipelines, professional management, as well as maintenance, and that infrastructure expands capacity, which means that when funding scales, you actually get entire neighborhoods delivered, not just one-off rehabs. And here's the twist. The same investors blamed for squeezing affordability can get over-leveraged, and right now, that's exactly what's happened. And so you might be pleased to know they're actually holding the bag. You see, when they buy aggressively during tight markets like 2020 and 2021, they pull forward future supply, both from their own build-to-rent projects and from eventual resales when yields go down. And that crowding in effect lifts inventory later, and high inventory is the one thing that every landlord has to pay attention to. So here's the bottom line. A surge in listings acts like de facto rent control. Seller concessions come back, renewal rents soften, asking prices get slashed in order to liquidate inventory. And don't take my word for it. If you want to see this in action, look at the cities where the floodgates just opened and prices, they're falling through the floor. And that's what we're going to be looking at next, because the truth is the best tells are on the ground in the markets that ran the hottest. And right now, these corporate landlords, well, they're stuck holding the bag. So if you're asking yourself, why are the same boom towns that set records in 2021 and 2022 suddenly flashing signals of a strong buyer's market? The answer isn't a mystery. It's inventory finally catching up with them, because when listings stack up, even frothy markets start to cool. And that's what you're seeing now across several of the Sunbelt metros that had a huge boom during 2020 and 2021. Let's take Tampa, Florida, for example. The S&P Case-Shiller has been showing month-over-month cooling there, while active listings keep climbing higher, and higher inventory gives buyers more choices, and choices, well, they slow bidding. So now, markets like this are having record days on market across all segments, and that includes entry-level homes that once sold in a weekend, they're now sitting, same with mid-tier, as well as luxury properties that need price cuts in order to get trafficked, and this shift lines up with what we laid out earlier. Once the pipeline opens, prices drop because of supply and demand economics. Truth is, a lot of headlines still frame this as a a looming crash driven by panic or investor flight, but the truth is a lot simpler than that, because oversupply is the catalyst that always brings prices back down to earth. When you see for sale signs flooding the street and builders start slashing prices, the negotiation flips in favor of buyers. Sellers chase the market instead of leading it, and renters and buyers alike see concessions creep back in on new lease-ups as well as home purchases. And Newsweek even reported that prices softening in several metros tied these increases to inventory, resulting in an extended time on market, not just investors exiting the city. And this distinction matters because if prices were falling because demand vanished, you'd expect thin listings and distressed comps dominating, but instead we're watching total available homes rise while buyers are just becoming pickier and home sales are only dropping by 10 to 15%. And Tampa offers a perfect example of this because multiple forces are pushing inventory higher all at once. First, we have new construction from projects that were approved in 2021 and 2022 that are now finally hitting the market, and investors who bought into peak rents are testing the resale market as carrying costs like insurance, especially in places like Florida, have increased, and homeowners who delayed listing during rate spikes are getting back into the market. And when you stack all of that inventory together, you get more for sale signs on every block, which leads to longer days on market, resulting in ultimately lower prices and better affordability. And you can also see this pattern in other Sunbelt metros where build-to-rent communities, large subdivisions, as well as multifamily lease-ups are finally finishing construction all at once. This is happening in Phoenix, Austin, as well as Jacksonville. And as soon as new inventory like this hits the market, vacancies go up and sellers start offering rate buydowns, closing credits, as well as outright price cuts to remain aggressive in a falling market. And you may be asking yourself, why are builders doing this now? Well, the truth is that these permits were pulled during the low rate era, and due to build timelines and permitting restrictions, they are just now turning into finished homes. Completions don't care that rates climbed later because investors had already committed money to the project, which creates an increase in supply that hits the market with a lag and not at the best time, at least for sellers, which is exactly the window you want to look for if you're trying to buy in one of these markets. And if that supply boost holds through 2026, the absorption of that inventory could last into 2027 and beyond. That's when list price reductions compound with seller concessions, and is also why tired inventory that's been on the market for months or even multiple years finally starts coming down in price, creating a buyer's market like we have right now. Historically, the metros with the biggest inventory spikes have offered the best long-term buying opportunities because you're getting into the market when sellers are most flexible. And here's the setup for what comes next. If you choke off corporate buyers, you also choke off a chunk of capital and the pipeline that's feeding the supply surge we're having right now that's causing an increase in inventory and a reduction in prices. And I'm going to be blunt for a second because I want to really drill this point home. I know you might want to hate corporate landlords, and I understand where you're coming from, but the truth is you should love them because these greedy will cannibalize themselves because they delude themselves into thinking that a market will never correct and will only go higher, which is why they're taking massive losses right now and left holding the bag. And it's in markets and states with the least regulations like Arizona, Texas, and Florida. Think about it. California and New York have some of the highest building regulations and rent controls in the nation, and this is also why they have the highest prices in the nation. Their policies are meant to help consumers, but ultimately the facts prove otherwise. And I'm not here to suck Wall Street's. In fact, they can go themselves. My point is that facts don't care about your feelings, so you need to stop being emotional. Corporate landlords are your friends because their losses can turn into your gain. You see, if you banned corporate landlords tomorrow, would rents drop? No. The gears that add new homes would grind to a halt. That's the real truth, because quick fixes that sound tough often break the very parts of the market that keep prices in check. You see, most ban proposals use thresholds. They cap ownership at, say, 5, 10, or 25 units per entity, and on paper, that draws a line between mom and pop and corporate, but in practice, it draws a map of loopholes, and the policies just target the name on the deed, not the total buying power chasing the same limited pool of homes. The truth is that these thresholds of how many homes you can hold or buy doesn't actually change demand, it just changes the behavior. If you create a hard cap, investors don't vanish, they simply reorganize, and they'll spin up more LLCs, use relatives or partners as title holders, or they'll pool capital through a small syndication like a 506B. And what happens is the same dollars are still bidding on the same properties, so competition remains in the market, only now it's harder to see who owns what, and enforcement becomes a cat and mouse game instead of being able to clearly see who owns what in a given market. Now here's how it all plays out step by step. An investor holds 40 rentals under one LLC. A new law caps entities at 10. So they form 4 new LLCs, each with unique names, bank accounts, and tax IDs, and they get 10 properties in each. Wow. Great idea. They draft an arm's length agreement and appoint different managers, and this ultimately just pushes title into trust or brings in minority partners so no single person crosses the cap. And on closing day, the county sees 5 small buyers, not one big one, but the net impact on demand is 0. It does nothing to make homes more affordable for you. And Redfin has argued that when you restrict large investors, purchases tend to migrate to smaller investors and individual buyers. The market share shifts, but the number of bidders doesn't collapse. That means the pressure on entry-level listings remains, just spread across more faces. And we're going to look at the build side in a second, but if you're enjoying this content so far, please hit the like button for the algorithm and consider subscribing to the channel. It's a free way you can show support, and it is much appreciated if you found this content helpful. And one request is give me your honest opinion in the comments. I know this is a contrarian take that you might not like, but are you starting to see how corporate landlords can actually make you money by driving prices down because of their own greed? All right, as promised, let's look at construction. So here's how ground up projects actually work. They rely on institutional capital, which is just a fancy word for pension funds, insurance companies, and credit lines, which are sized for multi-hundred unit build outs. So if you want to wall off corporate owners, lenders just reprice risk. And so what happens is construction loans get more expensive, terms tighten, and building starts, meaning new construction, gets deferred because developments can't show an exit to a scaled buyer or an operator, especially if they can't sell that finished project to a corporate landlord. And each delayed start is just a chunk of future inventory that never arrives on time, which drives prices up because it drives inventory down. And there's also a policy layer that you can't ignore. You see, analysis done by Fortune magazine as well as the Independent Institute point out that restrictive zoning and blunt price controls reduce maintenance, shrink investment, and stall new supply. When operating income caps and uncertainty climbs, owners just defer upgrades and builders pause, which erodes quality and it thins out the pipeline of new homes over time. And if you dry up development, all you're doing is setting yourself up for failure with a tighter housing market later, exactly when first-time buyers need relief the most. Without new completions, which is just a fancy way of saying new inventory or new homes on the market, this means that future years have less listings, which means you, the buyer, have less negotiating power and stickier, aka higher rents. You trade a symbolic win because of some policy for higher prices tomorrow. The better path is actually to make it easier to build more homes by deregulating building processes to encourage more competition instead of trying to restrict buyers. If you do that, the supply surge will keep rolling and corporate landlords and builders will be the ones left holding the bag, which might make some of you happy. And it's exactly what markets need to create more affordability and to get an epic deal on your first home. And the truth is that the fastest lever for affordability isn't a new ban. It's one thing, and that's inventory. When greed funds a wave of new listings and completions, which arguably there's no one greedier than Wall Street, discounts show up as price cuts, rate buydowns, and months of free rent as move-in incentives, which is what you actually want. So stop chasing headlines and outrage and look at the actual data and the fact. And you can do this in your market by tracking months of supply, active listings, as well as seller concessions in the markets you want to buy. This data is free and it's available on Fred Economic Data. If you literally just Google that, it will pull up. And when all of those metrics I mentioned rise together, you have the opportunity to get an awesome deal. Don't fight greed, embrace it. Because when listings stack up and corporate property owners are the ones left holding the bag, that's your opportunity, and step in to get a good deal at their expense. The key is to be patient, look at the data, and negotiate hard when you know the ball is in your court like it is in 2026 and likely for years to come. And if you're interested in working with me and need help as a buyer and seller, there's a link in the description on how you can get in touch, as well as opportunities for investors who are interested in networking. And right now there's a few videos popping up on the screen that YouTube thinks you should watch, so make sure you check those out if you haven't done so already, and we'll catch you on the next one. Peace.